Welcome back to 3 Cents. The U.S. supposedly taxes corporate income at a rate of 35%, but in fact, some companies pay a lot of taxes while others pay very little, with much of the variation based on industry. Retailers pay an average of nearly 30%, but some companies pay far less, particularly multinational companies in industries like tech and pharmaceuticals can often use creative accounting to move their intellectual property and therefore their profits offshore. President Obama is proposing a major change to the way the U.S. taxes corporate income that would aim to level the playing field, collecting tax from companies that shield their income and cutting taxes for many companies that don't. Here's how it would work. Currently, U.S. firms are supposed to pay tax on all their global income, but they only owe that tax once they bring profits back to the U.S., so they leave profits offshore. This is one of the reasons Apple is holding on to $178 billion in cash. Under the president's plan, companies would pay tax right away on all their worldwide profits, but at a reduced rate of 19%. They'd get a credit against that for most of the taxes they pay to other countries. So U.S. companies really earning profits abroad and really paying corporate tax in Europe or wherever wouldn't get hit. The idea is to tax the profits that somehow end up in places like Bermuda, where the tax rate is 0. So, is this a good and workable plan? To discuss, here is Eric Toder, co-director of the Brookings Urban Tax Policy Center and formerly the Deputy Assistant Secretary for Tax Analysis in Bill Clinton's Treasury Department, and Doug Holtz-Eakin, president of the American Action Forum, who was formerly director of the Congressional Budget Office and who was the chief economist for the Council of Economic Advisors under George W. Bush. Doug, I want to start with you. I know you've been critical of this proposal. Why is this not a good approach to making sure that U.S. companies, when they say they have foreign profits, that it's really not just profits that are being, stuffed away from the United States?
I think we should first of all applaud the White House for showing some flexibility in their approach to corporate tax reform. I mean, this is the first time they've shifted in 6 years, and I think that should be recognized. That the notion that we have to have a better tax code has been obvious, and so I hope that going forward we get one. The real issue here is that we have a fundamental competitiveness problem in the corporation income tax. Our competitor countries uniformly do not have a worldwide tax. They pay only taxes in the home country, and then if the money goes back to Germany or goes back to the United Kingdom, there's no second layer of tax. This doesn't fix that problem. It may change the nature of the way we collect the tax, but it doesn't improve the competitiveness of American firms and their workers. And as a result, we're going to continue to both lose the competitiveness battle, and as we've seen in recent years, we continue to lose the headquarters. And our firms are at a tax disadvantage, and other firms recognize this, and increasingly we're seeing foreign firms acquire U.S. firms because they can use those assets, use those workers more efficiently because they don't have the same bad tax code handicapping them. We just have to fix that, and the president's proposals don't.
Eric, what do you make of this proposal? It sort of puts us somewhere in a hybrid position between a worldwide system and what Doug is describing as a territorial system. The president would have a 28% tax rate on income here. The minimum rate for income abroad would be only 19%, so it would differentiate between income here and income there. Is that a reasonable approach?
Well, I think all countries in the world really have a hybrid system. These labels, territorial and worldwide, are very misleading. Every country, all the developed countries, have some rules called controlled foreign corporation rules that tax some of the overseas profits or the shifted profits of their home multinationals. What's happened is, Doug is right, many U.S. companies are at a competitive disadvantage versus foreign-owned companies, but that's true in certain markets, but it's also true that foreign companies are at a disadvantage in some places. I was just recently at a conference where Germans were complaining about Amazon coming in and stripping profits out of Germany. It turns out U.S. companies are very successful at more successful stripping profits out of foreign countries, and foreign companies are more successful at stripping profits out of here. So it's a very, very mixed picture. What Obama is doing is changing the hybrid system we have from one where we tax profits at a 35% rate, but only when they bring it back, to one where we tax foreign profits at a lower rate, but as they accrue. I think that's the right approach within the framework of the system we have now. I'm actually in favor of more radical reforms, but that's not on the table. President Obama's approach is very similar to the approach that's in Dave Camp's bill. He has higher rates on foreign profits than Camp does. He also has a higher transition tax. But what we're talking about when we're talking about the comparison of the two provisions are not philosophical differences. They're differences in numbers and rates, and I think those are negotiable.
Yeah,
I think everybody's bought onto the proposition that you don't want to tax the profits anymore when they come back.
Yeah, Doug, I think Eric points to something important here, which I feel like we've seen a real convergence in the ideology on this. You have Democrats saying, I think clearly for the first time, that we ought to have a system that is less worldwide than we have now, that recognizes that once profits are taxed at some non-tax haven rate in a foreign country, the U.S. does not get another bite at the apple to tax them again. And that means that when a U.S. company does business in Germany and a U.K. company does business in Germany, there's no tax disadvantage to the U.S. company of having to pay a second layer of tax to the U.S. And then on the other side, I mean, Republicans that have beaten the drum about we want a territorial tax system, but there's a recognition that every system is to some degree a hybrid system. You need some rules that make sure that when a company comes and says, well, this is my U.S. income, there's a check against that and says, well, no, really, this is income that you're saying was earned in Bermuda, but it was really earned in the U.S. So isn't that, now that we have agreement that we need a system that is sort of territorial and has some sort of anti-abuse provisions, can we then work out the numbers and get a bipartisan agreement on it?
One would hope so. I mean, I want to agree with Eric. The labels worldwide and territorial don't mean anything. In the end, all these systems are hybrids to some extent, and the question is, do we have a hybrid system that meets the tests of simplification? And I don't think this does. I want to come back to that. Meets the test of competitiveness and helps us have overall a more efficient tax code. On the simplification front, I think one of the things that hasn't been discussed much about these proposals is there's an enormous 40-year step backward in this proposal that goes back to having a country-specific foreign tax credit. And that was viewed as unworkable in 1976. In 2016, it's going to be even worse. The complexity is going to be enormous. I think they need to rethink that. It's not genuinely tax reform if it gets more complicated instead of being simplified. The second thing I worry about in this is the U.S. is essentially saying, and the President is saying in particular, you know, you're a tax haven if you're below essentially 22%, given the complexities of this proposal. And why is that the right number? I would prefer to have a system that doesn't say, we know who tax havens are because they have lower than 19% or lower than 22% tax rates. I prefer to have a system that takes the anti-abuse provisions and puts them in different places rather than picking in the rate. We want to have more flexibility on rates in our system.
Yeah, Eric, what do you make of this 19% minimum rate? As Doug describes, because of some rules about how the credits work, really, you'd have to be taxed in the low 20s in other countries to owe no further tax to the U.S. That looks high to me. I mean, the U.K., for example, has a 21% corporate income tax rate. Is this the President trying to bid high so this can get bargained down to a more reasonable level?
Yeah, I think so. I would interpret this as a starting point. I think we're probably going to end up with a somewhat lower tax rate. I agree with Doug on that. I do want to point one very interesting part of the President's proposal is that he's only allowing 85% of foreign taxes to be claimed against this minimum tax. And I think that's interesting because one of the aspects of the foreign tax credit that's concerned is basically if companies have a foreign tax credit, it makes them indifferent to the rate that foreign countries impose. So having some limitation makes them a little bit aware of the fact that they are paying taxes to foreign countries, and the United States is not bearing 100% of the cost of that. So I think that's an interesting part of the proposal. Hasn't been discussed very much.
Yeah. Doug, you talked about simplification. One thing that concerns me when we're trying to figure out what's a tax haven, what's not a tax haven, is that it feels like the corporations are always sort of a step ahead of the regulators on this stuff. If you come up with a set of rules about what's a tax haven, then people will figure out how to structure around that. There's an appealing simplicity to the minimum rate, where basically, you know, the country where you're doing business can have whatever rules they want, but so long as it adds up to this tax bill, then we're not going to come after you for any more money. If it doesn't, then we will. Is it really possible to have a system that doesn't use a minimum rate, but that still effectively identifies the use of tax havens?
We are never going to have a simple international tax code. I think that everyone just needs to recognize that. Simpler would be better, more effective would be better, but in the end you have to identify, you know, where profits are earned, and that means you have to have sales and costs, And there's some costs that are shared across all companies' operations. I mean, the headquarter overhead costs, things like that. So there are always going to be complicated allocation rules. There are always going to be a lot of complexity before you even get to the rate you're going to charge. So just having a minimum rate doesn't solve the complexity problem. It's appealing, I agree with that word, but the reality is always going to be very different.
Finally, I want to just get both of you in very quickly on this. Often discussions about corporate tax reform and international corporate tax reform focus on the question of shipping jobs overseas. Now, when I look at this, if we did this tax reform or some tax reform that was more congenial to either of the approaches the two of you would like, my impression is that the impact on job location would actually be very small. The main thing that would change is how much tax the U.S. government collects. Is there any reason to think that this is a big driver of either jobs moving into the U.S. or jobs moving out of the U.S.? Eric, I'll start with you.
No, I don't think so. In fact, what's more important in terms of the competition for jobs or investment is the rate that the corporate tax rate, and not just the statutory rate, but the effective rate. So if we're lowering our statutory rate but cutting back on depreciation provisions, as is in some proposals or in the Camp bill, we're not necessarily increasing the incentive to invest in the United States. But it's really the comparison of the rates, effective rates, that matter for that, and not so much the international rules. Those affect which companies, what Doug was talking about, which companies get ahead in the game. But, you know, whether it's a foreign company providing the jobs or a U.S. company is of secondary importance, I think.
Doug, do you agree with that?
I think Eric's hit a very important point, which is what matters is making the U.S. an attractive place for people to invest and to actually have foreign firms want to locate in the U.S., invest in the U.S. It's not a jobs issue, but the quality of jobs would go up. Pay would go up. You know, wages go up. The benefits go up. That's the key. And the rate is really important. And one of the things I think the president needs to think hard about in these proposals is 28% is not low enough. I mean, there's a pretty good recognition that getting to 25 would put us in the middle of the pack, would hardly put us in the position of being a wonderful place to locate and grow. So I don't think a lot of effort should be put into pushing that rate down further, if at all possible.
Doug Holtz-Eakin, Eric Toder, thank you so much. All right. That does it for 3 Cents today. Be sure to check us out every Friday at 8:30 a.m. Eastern right here on Shift by MSNBC.